Welcome to InvestorHubX.com. Some indicators are glanced at briefly and forgotten. Others become permanent fixtures on the charts of professional investors, fund managers, and long-term traders. The 200-week moving average belongs firmly in that second category. Over the years, this indicator has become one of the most respected long-term tools in financial markets, especially in stocks and cryptocurrency. In this video, we will discuss: what is the 200-week moving average? Why is the 200-week moving average important? How do traders and investors use the 200-week moving average? If you find this video useful, please give this video a thumbs up and subscribe to the channel, as this helps us create more high-quality educational videos for everyone. Let's get started. To recap, a moving average is a technical indicator that calculates the average price of an asset over a specific period of time. For example, a 50-day moving average calculates the average closing price over the past 50 days, while a 200-week moving average calculates the average closing price over the past 200 weeks. In general, shorter moving averages react faster to price movements, while longer moving averages provide a clearer view of the long-term trend. Different moving averages serve different purposes. Short-term traders might watch a 20-day or 50-day moving average to capture momentum swings. Intermediate investors often follow the well-known 200-day moving average. But the 200-week moving average operates at an entirely different scale. It captures nearly 4 years of price history, smoothing out everything except the most fundamental long-term trend. Think of it like this. The daily chart shows you the weather. The weekly chart shows you the seasons. The 200-week moving average shows you the climate. One of the main reasons the 200-week moving average is important is because it helps identify the long-term trend direction. The most fundamental use of any moving average is identifying trend direction. When price consistently trades above the 200-week moving average, the long-term trend is generally considered bullish. When price trades below it for an extended period of time, the long-term trend is generally considered bearish. Large institutional investors often operate on multi-year time frames. The 200-week moving average is one of several tools they may use to analyze long-term market structure. When major institutions collectively begin viewing a level as significant, the resulting capital flows can create powerful reactions around that price area. Unlike traditional horizontal support and resistance levels, the 200-week moving average changes value every week. This makes it a dynamic level. As a result, the 200-week moving average often acts as dynamic support or resistance over the long term. So, how do traders and investors use the 200-week moving average? One important use of the 200-week moving average is identifying potential buying opportunities during major market corrections. When a major asset, such as a stock index or Bitcoin, experiences a sharp decline and approaches its 200-week moving average, many long-term investors begin paying close attention. The idea is simple. If the long-term trend remains intact, a pullback towards the long-term average may represent a meaningful discount compared to recent prices. This does not guarantee a rebound, but it can provide a rational, data-driven area for investors to evaluate potential long-term positions. Some investors even build the 200-week moving average directly into their long-term strategy. A common approach is to gradually buy more when price falls near or below the 200-week moving average during major market downturns, and slowly reduce exposure when price moves far above it. This is based on the idea of mean reversion, the concept that over long periods of time, price tends to move back toward its long-term average, rather than staying extremely high or low forever. Short to medium-term traders also watch the 200-week moving average for important price reactions. For example, a strong bounce from the 200-week moving average on high volume, especially after a major decline, is often viewed as a bullish signal by technical analysts. On the other hand, if price repeatedly fails to stay above the 200-week moving average, it may be interpreted as a warning sign that the long-term trend remains weak or bearish. If you find this helpful, please visit InvestorHubX.com for more lessons just like this. We are building a complete learning platform designed to help investors like you master technical analysis, stocks, cryptocurrency, commodities, precious metals, property investing, and more, step by step. You will also get access to custom indicators and in-depth video courses to support your learning journey and take your skills to the next level. To summarize, in this video we explored the 200-week moving average, one of the most respected long-term indicators in financial markets. We learned that while shorter moving averages focus on short-term momentum, the 200-week moving average helps investors understand the bigger picture and long-term market trend. We also discussed how traders and investors use it to identify trend direction, potential buying opportunities during major corrections, and important support or resistance reactions. Although no indicator is perfect, the 200-week moving average remains a powerful tool for analyzing long-term market structure. If you found this lesson helpful, please give the video a thumbs up, subscribe to the channel, and turn on notifications for future lessons. I'll see you in the next video.